I think the world should now be able to figure out what should have been obvious back then, but wasn't for whatever reason.
When we say, gold is up, what we're talking about the dollar price of gold. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So there's just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar.
The Fed has moved into a policy from which it can never extricate itself. When we went to zero, when we did QE, people initially thought it was temporary and that the Fed could normalize rates and shrink its balance sheet. The Fed's printing press, it's starting to sink in, and they're getting rid of their dollars and they're buying gold.
Jim, you as well, you've called for new highs for gold. Tell us about how the current price level fits with your macroeconomic thesis.
Well, it's a big increase in particularly a pretty short period of time. Peter's right, it's been a long haul from 2011. But the thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. The bear market started in 2011, but it really fell off a cliff in 2013. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time.
Peter, do you agree? Can we be seeing a 50% retracement before prices rally more?
The big retracement of that original bull market, where gold went from under 300 to just over 1,900. I think we've now formed a very solid base, really between about 1,200 and 1,500, which is where gold was trading for most of those years since it peaked. And now I think we've broken out of that range. I think we've taken out the highs. I think it's another leg of the bull market. I don't think there's going to be any significant pullbacks from here. I mean, there'll be pullbacks, but I don't think they're going to be very significant. I think if you're waiting for a big drop to buy gold, you're going to wait a long time. And when you finally get it, I think it's going to drop from a much higher price than it is if you just bought it right now.
So I've spoken to an economist recently who told me that if you look at the last time that the Fed expanded its balance sheet on a significant level, during the last recession, what we saw was gold rising in tandem along with the expansion of the Fed balance sheet.
Well, remember, too, the only reason that gold stopped rising at 1,900 was because the world was convinced that the Fed could unwind the policy, that it could normalize rates, that it could shrink its balance sheet. But I think now it's not just the dollar severing its ties to gold, it's going to be the world severing its ties to the dollar. The world is going to go off the dollar standard and back on the gold standard. And I think that this is going to be a more precipitous drop in the dollar's value than it was in the 70s. And so we could see something equally as impressive in the price of gold.
We're going to talk about the dollar in just a minute, but Jim, let's go back to the first question here. Where do you think gold is headed from here? Are we overheated? Do you see more room to climb?
I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, 7,000 first. So there's plenty of room to run. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market's going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025, and at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? If you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't, But each dollar increase is a smaller percentage increase. But the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. The percentage increase gets to be pretty small at those levels. That's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. So Peter's right. My numbers, I think, are conservative. They could be much higher.